As the world adjusts to another Trump presidency, many sectors have started thinking about what possibilities could lay ahead. The entertainment industry, and streaming in particular, sees opportunity. Here's what Warner Brothers Discovery CEO David Zaslav said on the company's earnings call on Thursday.
We have an upcoming new administration, and, it's too early to tell, but it may offer a pace of change and an opportunity for consolidation that may be quite different, that would provide, a real positive and accelerated impact on this industry that's needed.
To discuss the possibility for that consolidation, as well as earnings that were out this week from some of these streamers, joining us is Ken Leon, CFRA Director of Global Fundamental Research. Ken, it's good to see you here. So interesting that Zaslav just sort of addressed that issue directly here. What consolidation do you think is left in this industry? What do you think is most likely to come potentially?
Well, it's probably not going to be the transactions that he would want. They're really in a position of weakness. The legacy entertainment companies trying to catch up to Netflix, it's a really tough battle. And overshadowing all this are the dominant tech social media companies that are moving into video streaming. So where does that put us? There's, of course, legacy assets that want to be sold, whether they're local TV stations or cable channels. Some of these will be packaged. And then because streaming requires so much capital, not only for the technology platform, but also for content and programming, we'll probably see partnerships. But I don't think you're going to see these mega mergers of really companies that are declining. Same situation with Paramount, but in that case, first half of next year, Skydance Media will take control. They are a producer of entertainment content and is likely to downsize or move away from distribution. So there's a lot of cross currents here, but technology has created a very different business model that's hard for some of these companies to catch up. And we're going to have Disney report next week as well.
So it sounds like, Ken, you're saying even if under this new Trump administration you saw a friendly regulatory backdrop, a friendly antitrust division, it doesn't sound like you'd be looking for a lot of pickup in deal making. Is that fair?
Well, there will be assets that are sold, but in terms of expecting that enterprises are going to be bought out, especially of the size of a Warner Brothers Discovery, is probably not likely. Additionally, there's a lot of second-tier companies that obviously the writing's on the wall, so hopefully they can catch on to a private equity firm that sees at least a predictable cash flow stream. But it's not the areas of growth. It's not where entertainment is going. It's going really to video streaming. And that's exciting, but it's been enormously challenging. What's interesting here, listening to Comcast on their earnings call, is that they're really beginning to mirror Disney. They are expanding dramatically into theme parks. They have a great broadband business, which is not affected here as much, including wireless. So when they begin to look at the assets that they have for video, it's likely that they're going to look for partners as well with Peacock.
Interesting. Where do you think that they would look?
I think it's mostly looking at second-tier players. The surprise that we would all have fun talking about is if Apple or Amazon Prime Video looks into some of the businesses that these companies have and decide that they want to own it.
Ken, if you're a streaming service, can you compete and win today if you don't have sports?
Live sports is a recipe for success. If you don't have it, it's a recipe for failure. And that was the challenge for Warner Brothers Discovery, losing out on the NBA sports rights. These are 10-year deals. And it's interesting, the stock was up yesterday, but where did they get 7.2 million subscribers? It was zero in the US. Those ads came all international. And you're getting 30 cents on the dollar on average revenue per subscriber. Warner Brothers Discovery, with their offering, is $12 in the US, It's $4 outside the US. So it's really a tough business, not the one where I think most investors want to be.
Ken, while we have you, we're going to hear from Disney next week, and I'm just curious how you think it's poised. Is that something that investors should be looking at going into its numbers?
They're going to take the high road. They're going to talk about their financial milestones for 2025. They should have quarter over quarter and year over year improvement with Disney Plus. And of course, there's a nervousness, although the stock has moved up from the mid 80s to 98 on the theme park, on the consumer. The message was that the consumer was feeling pressure, may not, attendance has come down a bit at the parks. So lots of questions there from the analysts. Additionally, in terms of movie releases, they're doing fine there. But, an overall picture here is we have to see more progress, net adds on Disney Plus, and probably getting out of some of their international businesses, which they're doing, like Hotstar in India.
Ken, great to see you on the show. Thank you as always for joining us.
Thank you.